Bank, HDFC Life as well, down about 1 to 5 odd percent. Strips of that, it's the Bajaj twins that are also not doing that well. Bajaj Finserv Finance are down about half odd percent, and IndusInd Bank is also down about 1%. So that's the opening tick. 100 points low on the Nifty, losing a lot of its gains from yesterday. On the upside, you have ICICI Bank that's up about 2 odd percent. Adani Enterprises, Axis Bank, L&T, Nestle, Kotak Mahindra Bank that are in the green. Hero MotoCorp is also up about 0.3%, not too much. Britannia comes out with numbers today. That stock is holding up in the green ahead of its earnings, up about half odd percent. Tata Motors, Eicher Motors, M&M, so all the auto names are doing pretty well this morning. But otherwise, the market is being dragged down by the HDFC twins, and the advance decline ratio is still in favor of the advances. So the market breadth is not too bad. Mid-caps are now sulking a tad bit, but plenty of stocks in focus in the broader markets as well. Nigel will take that forward.
Well, that's right. You know, one of the biggest losers right now is Manappuram. The stock is down closer to 9% post, the disclosures that came in from the ED. It's actually locked down closer around 10%. I'm just wondering whether or not Muthoot could be a potential beneficiary. That's holding more or less flattish as of now. But there are two core gold loan financiers, and if one loses out, I don't know whether the other one will stand to gain. We'll see how that plays out. So keep an eye out on that stock. Other couple of stocks that are in focus. TVS Motor. Sonia told us it's a good set of numbers. It's up closer on 5% as we speak. Valuation wise, well, it's not cheap, but the numbers look that good that the stock is up 5%. You have United Spirits as well. Some reports indicating that there's a price hike that's come about in Telangana. Could be positive on the margin for United Spirits as well as for Radico Khaitan as well. Both of them holding mildly in the green. BHEL, that stock is down closer on 6%. Not sure what's gone on there. And Dabur, the numbers came in late in yesterday's trading session. They were disappointing. The stock ended with a cut of front of 1.5% in an otherwise strong market. And today as well, it's a little bit lower. From the broader markets, you have, a couple of these names that are doing quite well. I think AGI Green Tech, to kickstart trade, that one was Greenpack. That was up and about. That's the erstwhile HSIL. So AGI Greenpack should come up for you on the screen. I think we have the management that's due later as well. The stock is up 20%. Volumes as well were decent. I don't know whether or not it's picked up, but it started out with the gain of around 10%, and those numbers are impressive. So that stock's up closer around 19%. We'll have the management in the next 90 minutes or so on our channel itself. But mid-caps in the green, Prashant. Nifty down 100 points. I
mean, mid-caps actually are solidly in the green, Nigel. So I'm looking at the advanced decline. The gap was not too much, but it's now full 2:1 advanced decline ratio. So broader markets are doing just fine. And the opposite of what we've seen over the last couple of days is playing out, which is that we opened full 151 points lower. As the low was made right at the word go, right out of the gates. And from there, we've recovered about 45 points from the opening level. So interesting to see. Of course, I mean, as we've been saying, the HDFC twins are bulk of the reason. There's always something, right? I mean, the Bank Nifty, we were saying, was just 1% away from highs. And boom comes this HDFC Bank out of the blue this morning. So 4% low, 4.5% lower on Bank, and Limited down about 4.5% as well. Nigel mentioned Manappuram, which is down 10%. There is a BHEL, which is down 4%. BHEL has been doing well recently. There is UBL, United Breweries, which is down 3% on the back of earnings. 1384, it was one of the names we highlighted in the morning. The sort of one-off wonders from yesterday, GIC is down 3%, and New India Assurance is down 3.5% as well. So, typical kind of price move here. Piramal Enterprises is down about 1%. What else? Bombay Dyeing is down about 3.25% as well. So this is, some stuff which is down. But the gainers list, of course, is longer, and lots of volumes here as well. Names like Tata Teleservices, Maharashtra, HCC, these smaller names have all been rallying, and we saw that yesterday as well. RVNL, IRFC, these stocks did see some profit taking yesterday, but they're back. Engineers India lost yesterday after last few days, prior few days of gains. EIL is back up about 3%. So there is interest and activity in this part of the market very much still. Data Patterns is another one which is up about 2.25%. So it's kind of spread out, but overall market breadth it's improving still. Almost 1,300 stocks are higher, and you got just about 500 stocks which are lower. The Nifty is down 100 points, and I think that is largely a function of what's happening to these two names. Actually, let me just quantify that in terms of actual numbers. So, you know, look at the Bank Nifty, for example. And the Bank Nifty, the contribution is, of course, massive, with the large amount of the cut, almost 60-70% of the cut coming through from just these two names. On the Nifty as well, we'll do that. Sanjay Mookim is with us. He's our market master of the day, strategist, head of India Equity Research at JP Morgan. Sanjay, good to have you with us here. Thank you very much. Once again, we are, in a way, if world markets can be described as a bit of a race, we are leading the pack, back at almost all-time highs in the fastest way possible. Almost there, not quite. What's your own sense, Sanjay? How are things looking? Does the price action match up with the earnings which we are getting and the situation on the ground? What's your sense?
Morning, it's great to be on. We've argued in our notes that India was set for a bit of a rally. And there are 2 or 3 things that I think favored us. One, valuations have come off. On the Nifty, at least, we were at peak of 22. We were down to 17.5-ish on lows. But more importantly, the premium that India had acquired to the S&P 500 last year, for a variety of reasons, all those premiums had completely eroded by the middle of, let's say, March or late Feb. And that kind of brought us in on a more favorable relative value platform, which was good for a lot of clients to look at. The second is that India's macro conditions have improved meaningfully. And principally, when we talk of that, we mean the pressure that we had on dollar outflows and RBI reserves falling because of very wide current account deficit. That has, for again, a variety of reasons, compressed meaningfully. So it gives the RBI room to be a little bit more pro-growth, not have to raise rates further. And more importantly, when you look at India relative to peers in EM or Asia, that kind of makes India look a little bit more favorable. The third thing that we have argued is that the sentiment on China has again turned negative for a while. And this is largely because the market is not going anywhere for quite a few weeks now. So client interest has moved from this big reopening of China trade back to looking for other ideas in Asia or EM. And again, India then becomes a favorable candidate within that. The last thing, Nigel, that we have argued in our research is that the business cycles indicators in India, whether it is jobs, whether it is wages, whether it is consumer confidence or corporate utilizations, they're all moving in the same direction. So given a couple more quarters, we do expect that whatever current narrative of weakness we have on consumption, even that should start to get addressed and fixed. So all these 4 or 5 things and the market having corrected kind of set up us for a big rally. I'm just surprised at the pace at which India's caught up very quickly, not giving too many people opportunity to participate, unfortunately.
All right. I just wanted to point out, by the way, one of the stocks of the moment is TVS Motor. It's hit a fresh 52-week high right now, and the stock is up almost 6%, so handsomely rewarding those earnings. It's not been a great year. I mean, it's been a good year, but nothing exceptional for TVS. It's up about 13% this year. But Sanjay, I wanted your thoughts. Some of these spaces that are barometers of rural and urban demand are picking up. So whether it's something like a TVS Motor, some of these companies in the FMCG space, but particularly for two-wheelers, how are you feeling about that space? Do you think the worst is over? And for investors, is there anything here?
Without talking about a specific stock, of course, Sonia, we do like the two-wheeler space conceptually, and the starting point is very simple. The aggregate sales of two-wheelers are still below where they were pre-pandemic, whereas every other sector in India has reopened and more. Four-wheeler sales are well ahead of where they were in 2019. Two-wheeler is not fully reopened. That is still due, and we're starting to see this happen. Now, whether this is driven by an improvement in credit flow, it is driven by the improving consumer confidence that I talked about earlier. There could be a variety of things that we could attribute this to. But essentially, we believe that the volume momentum we're seeing in the sector should continue. There are companies which are benefiting from it. Overall, we really like the two-wheeler space as being one that can benefit from this improvement in mass market consumption that we anticipate for this year.
All right. Hi, Sanjay. Good morning. Nigel on this side. Sanjay, when we chatted last in March, when you all were calling for a bit of a rally, the headline index, I think, is up a good 1,000 points. But I recall you telling us that from the broader markets and mid-caps, you don't mind missing the first 10% odd. But you'll want the markets to stabilize and then get in. Now, given that the headline index has gone up and maybe the headroom for the headline index is a little bit limited, is it now time to move more towards mid-caps? Incremental allocation goes to mid-caps, or you'll still stick with the large caps?
I'd still stay with the large caps. And what makes me a little bit nervous is that the valuations for the mid caps haven't really corrected. I mean, by correction, I'm not even asking for them to become cheap, even to get back to where they were pre-pandemic. In general, most of the smaller stocks are not there yet. They're still carrying a premium which is very unjustifiable. The growth outcomes for many of these smaller sectors is actually worse than that of the large caps. So you have adverse valuations and adverse growth. Yes, there is longer term potential for the smaller companies to grow faster eventually, but at some point this needs to show up in evidence. And given that there has been this rally at a time when the global macro remains weak, and you must remember that while we're talking of everything in India playing out in line with those 4 or 5 things that I spoke about, there is this Damocles sword of a bit of a crisis in equities globally. Should the market worry about Fed actions or US bank crisis or commercial real estate? There's a whole list of candidates that could spoil this party. So I don't want to stick my neck out and add beta even to Indian portfolios when I have a set of Indian large caps which will give me very decent compounding returns at decent valuations anyway.
Sanjay, we had Jahangir Aziz yesterday from JP Morgan, and I asked him about oil. And he said, well, what we're seeing right now, oil coming off, he said, I don't read it as positive. Basically, the oil market is divergent with equity markets, and it's perhaps forecasting a much steeper slowdown, global slowdown. So he said, well, I don't read it as positive. Your thoughts, and how does that relate to stocks and earnings? If oil were to stay here, what's your sense?
2 things. One, predicting oil has been the most challenging thing that anybody's...
Not predicting. Let's assume it stays here. After this 10% drop, we don't see... Many are still calling for it to go back to 100. I mean, who knows? But let's assume it stays at around the $72.
That will be very good for us, right? Because we are the second largest importer of oil in the world. It affects our balances. It affects the disposable income for consumers. So we'd love for oil to stay here. But Jahangir's point was right, that look, even after so much of OPEC action in cutting production, trying to tighten demand supply, if you see prices react negatively steadily, it's a very bad indicator of the perception of demand. Now, that might change eventually if demand comes back and China reopens stronger than people expect. But for now, oil is a signal of relatively weak demand on the ground. This is something that actually makes India stand out positively relative to EM. The 20-year chart of India relative to EM correlates to oil beautifully.
Okay. By the way, now the tire space has started to pick up quite a bit. Not the ones that have reported numbers, but the ones that are pending. So JK Tires is the one that's surging now, 5% higher. In fact, this entire piece, all the auto ancillaries also moving up with quite a bit of strength. But Sanjay, the other space that has looked very good, at least on ground, is real estate. From a stock market angle, is that a space that you still like? Do you think it's a multi-year upcycle that we're staring at?
We have liked it for quite a while, actually, Sonia, and we persist in that view. The concurring or the regular data points that we get on demand in terms of existing inventory or even new launches is pretty strong. There was fear that the rise in mortgage rates would kill the cycle. We are actually not seeing any of that happen at the moment. It is encouraging to my mind, and stocks haven't really done much. They've been hanging around for a while, perhaps because of these concerns on mortgage rates, perhaps because of the read-through of global real estate and so on. But the cycle remains robust, and we really like the space as something that should structurally continue for the next few years.
All right, Sanjay, what about IT? You'll have got it bang on till date. We have seen a lot of headwinds out there. Commentary hasn't been great as well. One would think there's no big reason to buy IT, with the kind of headwinds that we have, even at these valuations. But what if we see a correction of, say, 5 to around 10% on IT names? Will the large cap start looking attractive then? Because you'll have had an underweight call on IT, and you'll are maintaining that.
Yes, we are. Now, there are 2 responses to this. If you were to, let's say, on some of the large caps, value this on a long-term DCF, maybe the downside to some of the specific big ones may not be more than, let's say, 10 or 12% on a normalized growth assumption, right? The challenge we have is the timing of this trade, or to switch it into IT perhaps, because the down cycle and top line, the down cycle and profitability has only just started. The weakness we've seen in the March quarter doesn't even factor in the challenges in the small banks in the US. and the effect of that will probably flow through in the June and September quarters eventually. Maybe you can make the case that there is at best a 10-15% downside to a reasonable fair value, but there is always the risk that these stocks undershoot into the steady down cycle that we fear will come. We wouldn't jump in to buy any of these just yet.
Okay. All right, we will leave it at that. Sanjay, thanks a lot for joining in and taking us through your view. Appreciate your thoughts on CNBC-TV18. By the way, the market is, it's not bad actually. So, if you just leave aside the HDFC twins, it's a pretty good market. A lot of stocks are picking up now. Banks are moving with strength. SBI, ICICI Bank, tire stocks, auto stocks, a lot of heavyweights. ICICI Bank, by the way, is topping the charts now. L&T, Axis, Hero. So there's definitely a buy on dips that we're seeing. But time now for an exclusive conversation with Tata Power. The company reported a good set of earnings for Q4. The net profits came in above street estimates, while the revenue and EBITDA also surged. They have a strong solar EPC order book at over 17,400 crores. Praveer Sinha, who's the managing director and the chief executive officer of Tata Power, joins us now. Mr. Sinha, good morning and thanks a lot for joining in. Can you, we have the numbers with us, but can you give us some qualitative analysis on what FY24 could look like in terms of an operational performance and also the key contribution to profitability from the Indonesian coal operations? Can this profitability sustain? Because coal prices have corrected significantly from the highs in recent times. Your thoughts, sir?
Good morning, Sonia. Always a pleasure to be on your show. Thank you. I think the performance has been very good for Tata Power and consistently 14 successive quarters that we have shown a growth in PAT. But let me try to share with you that what has happened is over last few quarters, there has been huge consistency in the profitability and the EBITDA of the company. And that has been because our existing operations, which is our existing generation operations, coal, hydro, gas, all have done very well. Similarly, our existing transmission and distribution operations have stabilized. Our renewable operations, especially the generation part of it, has stabilized, and the availability of all the plants are more than 99.9%. So what is important is going forward, this will continue to be there. Now, the only difference is that when the coal prices goes up, the coal companies make profit, but the CGPL, that is the Mundra plant, that makes a loss. Now, if we look at both of them, they counterbalance each other. So if the coal prices comes down, the Mundra losses comes down also. And if it goes higher, the Mundra losses also becomes higher. So I think when we club both of them, they will be more or less quids, and we will not have a huge swing between the two. We will also start seeing the full benefit of the Odisha discom. We took over that between 2020 and 2021. And we have done a lot of cleaning activities. The AT&C losses have reduced drastically from range of 35 to 40%. They are in about 20% rate. And the full benefit of the acquisition and the improvements that we have done will start showing from next year. So I expect that qualitatively we will be more or less very stable in FY24 also. And our operations will continue to surprise everyone because we are bringing a lot of consistency in our performance.
Sure. Can you give us a little more details about the Mundra operations in Q4? How many days was the plant inactive? Is it fully functional now?
So in Q4, we did not operate the plant for a very long period. Only one unit operated, and that also for just about a month and 10 days. So about 40 days it was operated. And we were expecting that once the Section 11 comes, we will start operating. And now we are operating all the Mundra 4 units and supplying to all the 4 beneficiaries. Of course, Haryana is not taking, but other 4 are taking the full capacity. So, and this will continue, expecting that the existing arrangement is till 15th of June, but it may get extended depending upon what sort of heat conditions are there and what sort of demand requirement is there in the country. So I think we will continue to see good performance from Mundra in terms of availability of power. But yes, the tariff will come down because the coal prices have come down.
All right. Hi, Mr. Sinha. Good morning. And I just heard you saying that the profitability of low profitability of the coal mining business, that's a 30% stake all that you'll have out there, will be compensated by Mundra. It's difficult to imagine that, right? In the past year, 60%, 55, 60% of your PBT came in from this coal mining business. And now coal prices are sharply lower. I wanted your comment on it. Profitability could get hit.
I don't think so, because the coal profit is linked to the losses of Mundra. And if you have seen last year, the Mundra losses were high, and in the earlier years also. So the difference between the loss of Mundra versus the profit of coal mines is virtually a very, very small amount, and it is not making a huge impact. While in absolute numbers, it will look that the coal profit is there, but so is the absolute number of losses of Mundra. So I think if you combine both of them, we will never have a very high profit coming between the both the entities.
Right, Mr. Sinha, on the could you give us some numbers in terms of what the coal business financials looked like for the quarter?
I don't have the breakup of the numbers, but when we look at it, the coal numbers are not very good in Q4 because the coal prices have come down, and Mundra losses continue to be there. So I think, as I mentioned to you, there is not much of difference between the Mundra operation under recovery and the coal mining profit.
All right, Mr. Sinha. Mr. Sinha, if you could give us a few details. Mundra is functioning at what PLF, if you could tell us that. And also, I believe that the outstanding from SEBs has come down. So what has it come down by? I believe in the last couple of months, you've recovered a goodish amount.
Yeah, so so most of the payment has come from the procurers. So all of them, based on the order of CRC and APTEL, have made the payment. A very small quantity is left. I think about 500 crores is still left, but the rest of it is coming. And also, whatever we are now supplying, we get that payment on a weekly basis. So to that extent, Mundra is quite insulated in terms of the receivables from the procurers. More so because Mundra continues to be also in the merit order, and most of the procurers are scheduling power from Mundra. Today, now the 4 units are operating. 1 is under shutdown. So we are giving full 4 units availability to the procurers, and they keep on scheduling during the day based on their requirement.
I wanted to talk a little bit about the renewable energy business, because over there your solar EPC order book is very strong. It's over 17,000 crores. But can you tell us about the order execution timelines, also any visibility in terms of further orders as well from this space?
So the solar EPC business went little slow in last 1 year, primarily because of the supply chain disruptions, and also because the prices of modules were very high. But now that the prices have come down in last 6 months, so we will be executing most of these projects in next 12 to 18 months. These are very good projects that we had won, and we expect that some of it from the imported modules, and once our manufacturing facility gets ready by this year end, we'll start also using the modules produced in our own facility. So I think most of the projects, which is there, the 4 gigawatt of EPC projects that we have, which partly is in-house and partly is for third party, will get executed in next 12 to 18 months.
Mr. Sinha, I was reading a note from the analyst house, CLSA, and this is what they have to say about the real estate business, and I want your comment on this. They say, and I quote, this is on the renewable side. The key message seems to be that it is easy to win renewable projects and concessions, but that the focus should be on profitable growth. They go into lots of numbers, etc., how things have not looked good in the quarter which has gone by. As we head into FY24, could you give us some qualitative sense of what we should expect from the renewables portfolio? Because that's going to be a very, I think your presentation says it's going to be a very large part. I mean, 45% plus is going to be the renewable portfolio going forward. Go on, sir.
So last quarter, our performance of the EPC business has been fantastic. I don't know from where the data has come, but let me tell you that last year, our EPC business from Tata Power Solar has done maximum in terms of profitability, both in terms of percentage as well as in terms of absolute numbers. And that is because many of the projects where we were having challenge in terms of procurement, we have deferred it for the next year because we were expecting the prices to come down, which is our correct assessment, because we now find that in last 6 months, the prices have drastically come down. And we will be now able to execute all these projects at the margin at which we had bid. So what we feel very strongly is that our decision to defer will help us to get better margins when we execute these projects in next 12 to 18 months. Also, our manufacturing facility, the module plant will be ready by September, October, and the cell by end of the year, will help us to manufacture these modules in-house and use it, and that will be substantially lower than what we would have otherwise imported and paid the customs duty on that. So I think we are in good shape. We have always ensured that we get very good margins and very good return. And whatever are the bid numbers, we not normally stick to that. In fact, in many cases, we end up doing better than that also.
All right, Mr. Sinha, let's talk about two factors now. One is, you've mentioned about Odisha discoms. That business is doing very, very well. Now, if I do an addition from your PPT itself, the Odisha discoms business, the profitability is quite large. What kind of a run rate are you looking at maintaining out there? And also, you have 48%. That's in Tata projects, and that continues making a loss, which is hurting. When do you see that turnaround?
So, Odisha discom, we took over between 2020 and 2021. We had to clean up a lot of things, and based on the bid that was done, in the first 3 years, we were supposed to make losses in all the 4 discoms, but we've been making continuous profit right from year 1. And the profits have been after considering a lot of cleaning up of data and cleaning up of the billing arrangement which was there. All that has been done. So what we expect is our profitability in Odisha will actually increase many-fold going forward, because going forward, all the cleaning up process has been completed. And you will see that on quarter, the Odisha discoms will do very well. As far as Tata Projects is concerned, it has had a lot of onerous contracts where it has made losses. It has completed that exercise as to what is the cost of completion, and it has accounted for all that, though the projects have not been completed as yet. But whatever would be the perceived losses, they have accounted for and made provision. And I think what is important is that going forward, since they have cleaned up everything, we should expect profit and not losses which it had incurred last year.
From the second half of the year in Tata projects?
In the first half itself.
First half itself, lovely.
Okay, and on the Odisha discom, you said that the profits will improve substantially. Can you quantify for us what it could be? Ballpark?
Let's wait. We'll perform and demonstrate that.
Okay. Okay.
If I'm going through your PPT on, the summation is around 145 crores in Odisha discoms, as Sonia asked, on a quarterly basis. You want to give us a number?
So similar run rate for the year.
Okay. All right. In general, how are you feeling about power demand in FY24? What kind of growth are you looking at in the sector? And, in terms of PLFs, etc., how do you see them trending?
So I think the power demand has grown. Of course, it also is very much dependent on the weather conditions. We saw in last 1 year the growth of power demand by nearly 9%. And there has been huge increase in demand from all sectors, not only from the industrial and commercial, but also from the residential sector. And considering that universal access of energy has happened and every village, every town has now access of electricity, the consumption patterns have seen a huge increase. We expect that last year the peak was 216. This year it should be in the 230 gigawatt. But the rains in last 2 months have made the whole prediction little difficult to make. But I think going forward, if it becomes much warmer, the country is ready to meet the requirement of power.
All right, Mr. Sinha, final question before we let you go. You know, the broad feedback that we got from the sell side is that they want more disclosure, particularly on Mundra. You know, so let's see next quarter, I guess, you know, if you could make that, will be beneficial for the entire street to read these numbers. But before we wind down, your debt number has come down to around 35,000 crores. You've done some fundraise, some, stake sale, etc., in a couple of assets. What does that number look like? Will it stabilize out here? Is there a possibility of reduction? Or given that you have some capex, does it go up from here?
It will be in the same range. As you are aware, last year we did a capex of nearly 6,500 crores. And this year we are planning to double that to nearly 12,500 crores. And many of them, of course, will start generating enough cash to pay for itself. But till such time that happens, there would be a certain mismatch in terms of the quantum of debt that would be required. But I think we'll be more or less meeting all our future requirements of capex from internal accruals.
And we can look forward to further disclosures on the Mundra asset and the likes in the first quarter onwards?
I think we need to look at it that Mundra is today merged with Tata Power, and
yes,
it's a combination of Mundra and the various other businesses. And to the extent required, we give the details. But if there is someone who requires more information, we'll be more than happy to share.
All right, we'll leave it at that, sir. Thanks a lot for joining in and fielding all of our questions and giving us so much data. Appreciate your thoughts and your time on CNBC-TV18. Well, the market is still very quiet, actually, hasn't moved much. So let's take a quick break on that note. On the other side, we'll get you excerpts of our exclusive conversation with Suresh Narayanan, who's the MD at Nestle India, on their growth outlook. Also, with the US Fed signaling a potential end to rate hikes and the RBI pause on rate spells, are interest rates likely to come off? And if so, can that be an opportunity for debt and debt fund investors? We will figure out the same with Suyash Chaudhary of Bandhan MF and Lakshmi Iyer of Kotak Investment Advisors. Stay tuned. All right, welcome back to the show. We still have, the markets not doing too much as far as the headline index is concerned, but banks are really picking up pace. And we were making this point earlier about how the bank Nifty could perhaps get above that 45,000 mark. That's the next level to watch on the upside. Led by Axis, ICICI Bank, SBI, Kotak. It's only the HDFC twins because of the MSCI adjustment that's dragging the overall market. Otherwise, it's a fine place to be. But let's get some interesting insights from the FMCG industry. Nestle India's Managing Director Suresh Narayanan spoke to my colleague Mangalam about the company's growth outlook and product strategy. Listen into excerpts from that chat.
From the company standpoint, I'm looking at new pastures and new avenues for growth. I mean, we have been a successful company over 100 years in this country. we have some of the most iconic brands that are there with us. And yet there is even more. I mean, the inflection point of India has arrived. Today, aspirations need to be met with availability. And I think the Indian consumer, despite all the talk of global recession and various other economic pressures because of the war and other things, I think India is still a buzzing place.
Yeah.
Indian consumers are still willing to try new things, but try basis the trust that they have in brands. And I think Nestle is truly blessed to have brands that have been trusted over decades.
Give me some example of how agile and flexible Nestle has become since the time you took over.
One of the things we question ourselves is our pace of innovation.
Right.
And I'm happy to say that today, using the same processes, because one thing is to jettison everything and say, I'm not going to care for any of the processes, any of the safety nets that the company works on, and just look at launching products without any consumer meaning or insight. That's not the Nestle way. Nestle goes through a deliberate process. We go through a deliberate process, except that today we don't have two things. One, we don't have a fear of failure. And secondly, speed of response. If something is 60-70% ready to go, then go.
Right.
Don't wait for perfection to happen. And today, post the crisis, we have launched almost 123 new products. Our pace of innovation, Mangalam, is 3 to 4 times faster than it was 10 years ago. So, and it contributes about 5 to 6% of our sales.
What does all of this boil down to? I mean, I'm just looking at, the most important parameter in an FMCG company, according to me, would be the sales of a company. Are you looking at mid-teens sales growth? Are you looking at double-digit volume growth? How do you define that aspiration?
Look, I think one of the simple models, Mangalam, that we set forth 8 years ago is what we call the grow to win model.
Okay.
Grow to win simply means penetration-led volume growth, which means what? That people need to buy more of the category, more frequently into the category, and more of the category.
What was counterintuitive then was, why is it then you had to phase out the low unit packs or leave important price points in some of your star products? Case in point, something like Maggi.
Last year was an unprecedented inflation for us. The average inflation that we had to combat on an annualized basis was anywhere between 20 to 22%. Now, obviously, this meant that some of it we could find the avenues for in terms of what we call the shark savings, which is buying smarter, buying longer, and being more efficient in your recipes. And finally, look at pricing.
Okay.
And in looking at pricing, there were some parts of the portfolio that needed to be touched. But we touched those parts of the portfolio where we knew that we also have an upgradation of the portfolio strategy that is there in place. Maggi was a case in point, that there was an upgradation strategy there. It is in motion now, so I would not say that the journey has ended. Some of the things, Mangalam, I think a crisis brings is the ability to think outside the box. And I think that is prepares us well for times where we might face this in the future, but yet we are capable of taking it head on because of the capabilities that we have built.
That reminds me of another Kabir Doha which says, Dukh mein sumiran sab kare, sukh mein kare na koi, jo sukh mein kare to dukh kahe ko hoye.
Absolutely.
Which is basically what you're doing. You're sticking to the process during the good times so that when the bad times come, you will be pretty ready.
Absolutely. Absolutely.
Was there any impact of the price point movement on the market share?
Look, I think in some categories, and certainly in Maggi, and I referred to this earlier, there was an impact on volumes because obviously the price point that we moved out was quite sharp. But I'm happy to say that I think we have stabilized and now we are building back. On average, if you look at the company's performance in the last 6 to 7 years, we have been averaging a double digit. So about 10-11% on average growth, consisting of a price impact of about 3% and volume of about 7 to 8%.
Right.
We have maintained the charter of the growth engine of the company strong and secular for all these years. Last year we grew at 14%, but the volume delivery was lower than that. That has now again started to recover back. In the last quarter, our results had about a 5% volume growth, about 2.5 mix, which I count it as a positive sign that there is an uptrading that is happening. So about 7.5%, and the balance 14% was the price impact. As we go forward, we are expecting that the volume-led growth will strengthen over a period of time, provided, of course, that the inflation, which looks to be, as of now, a little bit more tempered as compared to what it was. Okay. If this continues, then I think we'll be back into the journey of penetration-led volume growth, which is the mantra that we will use as a company.
Okay, welcome back. 75 points lower on the Nifty, 18,180 is where we are at. So it's a slow but steady improvement from the day's lowest point. I mean, actually, it's a 75-point improvement from the opening gap. And that's a good thing, 0.4% lower. I think the broader health of the market is still okay. I mean, it's not 2.5:1. It's closer. 1150 stocks are higher. And the number of declines has also come up a little bit. It's about 850 stocks on the downside. There you go. The gap has really narrowed over the last 30, 40 minutes or so. Now, let's talk about interest rates, right? I mean, yesterday, for example, the Indian government 10-year fell to around under 7%. In the US, many expect interest rates to be cut at some point later. Although the debate there is more widespread here, I feel there is a bit more consensus that the RBI perhaps is done for now. We are seeing peak rates from the Reserve Bank of India. What does all of this mean? Equity investors have been telling us all this year that you should increase your allocation to debt. Is this a good time to lock in these rates right to the highs if this were the high? Suyash Chaudhary is head of fixed income at Bandhan Mutual Fund, and Lakshmi Iyer is Chief Executive Officer Investment Advisory at Kotak Investment Advisors. Thanks very much, both of you, for joining us. Good to have you here. Suyash, so that simple question to you, am I correct in characterizing the consensus view here? If that were to be true about rates in India, what's the right way to approach this from an investment point of view in terms of debt investments? Go on.
Absolutely. The Western world is slowing. Rate hike expectations globally are now peaking and they have matured. So there is unlikely to be any volatility around that anymore. India has compressed its external account very remarkably. So external imbalances that faced us last year are out. Inflation is on a downhill trajectory. So we do think we are at the top of a rate hike cycle, and investors should be looking at quality fixed income, especially in the 3 to 6 area in our view. That would curb reinvestment risk as the cycle matures and some modest amount of rate cuts come through, even in India, probably over 2024.
Lakshmi Iyer is also with us. Lakshmi, hi. Always great speaking to you on the channel. We're in a situation where perhaps we have seen the last of the rate hikes from the US Fed, and now we could be maybe heading into a rate cutting cycle as well, although the Fed has not made that amply clear, but that is one narrative that's doing the rounds. In such a situation, what's your own view? What's the best way to approach the debt market?
Yeah, hi, morning, Sonia. Definitely the bond markets are in a situation where there is the cake and there is a cherry on the cake moment where the global headwinds are also kind of morphing itself into tailwinds, given what we just saw of the Fed outcome. And you're absolutely right, though there is no explicit comments of a pause. If you actually look at the Fed fund futures, they've already started indicating rate cuts. And that's reflective in the bond yields in the US, where the 10-year is trading at 3.34. So clearly, the momentum seems to be sustaining in the Indian bond markets also, where we have seen the yields come closer to the 7% mark. And more importantly, if you see, you look at the swap curve, the interest rate swap curve, the 5-year OIS is already trading sub 6%. So I think these are clearly telltale signs that puri kainat jud gayi hai to ensure that the bond market participants tend to gain.
That's an interesting phrase, Lakshmi. But is it too much of a consensus? Or you think, I mean, the consensus does not have to be wrong, I mean, it can be right. Are we in one of those situations?
See, if you look at the macro data points also, if you look at the inflation numbers which are likely to release, in the upcoming week, the trend line clearly seems to be headed on the lower side. That's number one. Number two is markets typically tend to discount events ahead of its happening. So while we are not rooting for a rate cut, clearly this is the phase where interest rates have plateaued out, and in a plateaued out scenario with expectations, maybe with a lag of maybe 3 or 4 quarters, depending on which region you are, whether it's the US or India, it looks like positioning yourself for that outcome is absolutely imperative. So it's not more about consensus. Also, investors need to keep in mind that it's not going to be a slam dunk that, the moment you invest, yields only keep sliding on the lower side. It's going to be range bound because there is a week on week supply.
So, Lakshmi, sorry, Suyash was saying that the correct bucket to look at is the 3 to, I think he said 3 to 6 year, if I got that correct, to avoid reinvestment risk, etc. Would you agree?
3 to 6 year, the bucket, as we call the belly of the curve, looks pretty attractive given that the yield curve is inverted or flat as we call it. So yes, risk reward clearly warrants allocation in that bucket right now.
Okay. Suyash, how about you? What kind of returns on an average can investors expect now in the bond market, say over the next 12 to 18 months?